Today, I'll be breaking down Nvidia's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Nvidia's growth narrative is truly exceptional. Over the past decade, the company achieved a remarkable 986.4% surge in revenue, showcasing an astonishing annual average growth rate of 26.9%. The growth trajectory continued with earnings per share, demonstrating a remarkable overall growth of 4,111.1%, equivalent to an average annual growth rate of 45.4%. Concluding the first dimension, the free cash flows exhibited a notable total growth of 2,936.0%, averaging an impressive 40.7% per year. The sheer magnitude of these figures leaves me speechless. Unquestionably, Nvidia earns a perfect 5 in the growth dimension, a testament to the remarkable progress it has made over the past few years. Now, let's shift gears to profitability dimension. Nvidia has consistently demonstrated a robust performance in profitability, boasting an impressive average gross margin of 60.2% over the past decade. Remarkably, the current gross margin has increased even further, standing at a notable 69.9%. Nice! Turning our attention to the operating margin, it currently stands at an impressive 45.9%, significantly surpassing the 10-year average of 27.0%. In free cash flow margin, Nvidia has maintained an average of 19.9% over the last 10 years, with the present value surging to an impressive 31.7%. Lastly, in return on invested capital, Nvidia has exhibited a remarkable 53.5% average over the last decade. Astonishingly, the current value has reached an exceptional 68.6%, reflecting a remarkable return on the capital invested in the company. Another perfect 5 for Nvidia. Moving on to the solvency dimension. The quick ratio, with a 10-year average of 4.98, remains robust, even though the current value has slightly decreased to 3.17, still a more than secure position. The debt-to-equity ratio, which averaged 0.36 over the last decade, has maintained the level and it currently stands at 0.33. What net debt-to-EBITDA ratio shows is that Nvidia has got more cash than debt. Lastly, in debt-to-free cash flow ratio, it is astounding to note that Nvidia could liquidate all its debt using the cash flows it generates in a mere 0.78 years. I'll repeat, Nvidia can pay off all its debts within less than a year based on the cash flows it generates yearly. It's frightening what we are experiencing with this business. I've never seen anything like this. Another perfect 5 to Nvidia. Now, let's focus on the crucial fourth dimension, valuation. When we look at how expensive Nvidia is, it's like looking at two sides of a coin. On one hand, comparing the current multiples to its 10-year averages, Nvidia seems fairly priced. You can see this in these charts. But on the other hand, if you just look at the actual numbers, like the price-to-free cash flow ratio at 174x and the price-to-earnings ratio at 88x, it seems pretty pricey. But here's the twist. When we think about how much Nvidia is expected to grow in the future, it might make these high multiples more reasonable, as one might think that Nvidia will grow into these valuations easily. Soon, the full picture will become clearer as I'll dig into a discounted cash flow valuation. So, stay tuned for a closer look at the true value of Nvidia's business. The fifth and last dimension is the shareholders' return. Looking at dividend growth, Nvidia achieved an impressive annual average growth rate of 7.2% over the last decade, resulting in a total increase of 100% in its dividends. This is undeniably outstanding. However, a closer look reveals that Nvidia hasn't increased its dividends since 2020. Examining the shares outstanding metric, it shows that Nvidia has slightly diluted its shareholders over the past 10 years, with a 4.7% increase in the number of outstanding shares. While this isn't a significant dilution, it's worth noting. The good news is that Nvidia announced a $25 billion buyback last year, indicating a plan to reduce outstanding shares in the future. To wrap up this last dimension, the payout ratio is currently at 2.8%, which is incredibly low. This means Nvidia's dividend is more than safe. In this table, we have a summary of this section. The 5 dimensions final rating is an outstanding 4.1. Now let's move on to Nvidia's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Nvidia's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices Nvidia's stock fair value at $706.32, 29.1% above the current stock price, which indicates that the stock is undervalued. The bull case prices Nvidia's stock fair value at $1,102, more than 100% above the current stock price, which indicates that the stock is deeply undervalued. Finally, the bear case prices Nvidia's stock fair value at $394.10, 28.0% below the current stock price, indicating that the stock is overvalued. In summary, Nvidia earns an outstanding 5D rating of 4.1, and its weighted average price target is $723.08, implying a 32.2% undervaluation. Putting all together, my final verdict is, next round, Analysis 2.0. Nvidia's business performance is truly extraordinary, reaching levels that seem almost otherworldly. The impressive growth they've experienced appears to be just the beginning. Adding to the fascination with the business is the fact that, even when factoring in anticipated cash flows for the coming years, Nvidia doesn't appear to be overvalued. But let's not get ahead of ourselves. The verdict is still pending. Prior to any investment commitment, I intend to conduct a thorough analysis of Nvidia's business and financial statements in Analysis 2.0. Don't forget to subscribe to my channel and stay tuned for the next analyses.